Welcome to the Untold Stories of Real Estate Investing, hosted by Wayne Courageous III, a place where active and passive investors come to hear the good, bad, and ugly of real estate investing. Our guests consist of experienced operators and investors who want others to succeed by sharing their stories. If you're looking to syndicate deals or grow your wealth passively in real estate, you've come to the right show. It's now time to sit back, take mental notes, and enjoy our next episode of The Untold Stories of Real Estate Investing.
Welcome to the Untold Stories of Real Estate Investing. I'm your host, Wayne Courageous. For our next episode, we're excited to have Amy Tiemann. Amy is the founder and chief executive officer at TM1 Properties, a commercial real estate private equity firm. Amy's first multifamily investment was in 2010. At this point, Amy was becoming active in multifamily investing, real estate investing, while also managing their construction business. By 2015, she made the decision to focus primarily on real estate investing, and in 2017, she went on her own. In addition to investing, Amy has taken on property management. Welcome to our show, Amy.
Hey, thanks for having me.
Yeah, so before we dig in, was there anything I missed or anything you want to add to introduce yourself?
No, that sounds good. That's a pretty good synopsis of me. Yep, okay. Been doing real estate investing for a very long time. Started as a general contractor. I guess we can talk about that. That's how I got into real estate investing. So I was a general contractor before that. So, yeah. Perfect.
And it was your family business, what I read, right?
Yeah, my husband at the time and I started it back in, my grandfather had started a glass company. And then, so I remember with my dad riding around in the truck, going to job sites and stuff, and kind of grew up in construction. And then when I was working in HR at a large tech company in Austin, and during the downturns of 2001, and made it through till about 2003. And after it was the 8th layoff or something. And I was in HR. And so then I had already kind of was helping my husband at the time with the construction company because he started it, and I was still doing both. But so we decided I'll just work with that full time. And so we started. We were building retail stores. We started the retail side, so commercial, and then we're about 16 states at one point doing commercial construction. So that's how we got started. So yeah.
So how has your career progressed from that? Tell us about that first property in 2010, and sort of how has it grown over the years? Have you stuck with multifamily, or are there other asset classes that you've focused on?
Yeah, there's other asset classes as of this year. Prior to that, it was strictly multifamily. So I was multifamily and single family rental for a while. 2015 went full-time multifamily just because I couldn't find a single family house that made sense, that I could buy at a reasonable price. Because all my single family rentals were in Austin. And so then when 2015 got out of single families and then got into multifamily, straight multifamily stuff from 2015. And then I got divorced in 2017. So I just stayed in multifamily. So, and now that I've kind of rebuilt myself back up since 2017, because I had to sell off a lot of assets and stuff that we owned, and we had businesses together and stuff. And so I kind of had to recover from that. And so now I'm in multifamily. I'm looking at office, and I'm also looking at retail projects too. So yeah, all kinds.
Yeah. Are you looking at office and retail now that we're post-COVID? Do you see opportunities there, or what's branched you out to those asset classes?
I'm contrarian. They're cheap. I think it's going to come back, especially if you're in good markets like Austin or anywhere in Texas, for that matter. I think, retail will come back. We're already starting to see that it's coming back in certain areas, right? I mean, it was just hit, had to be put on pause out of no fault of its own, right? I mean, just like any other multifamily operator, if you were a bad operator and COVID happened, well, you're just a bad operator. It just did you in, right? But if you were a good operator and COVID happened, you made it through because you were a good operator, right? Same thing on the retail side. A lot of the retail stores that went out, like Macy's or wherever, they were already in trouble. COVID did them in sooner. It probably did them a favor. They kept losing. They were just losing money all the time anyway. But yeah, so it's something like that. But I like REIT, since I have a construction background. So some of the stuff I'm looking at is doing adaptive reuse, or it's really ugly. My thing is I take ugly and I make it pretty. So whatever I'm buying, it's going to have that component. It's going to have a value add. I'm going to take the site and then do some redevelopment on the site, reuse the site that maybe it's not being used very well at all. It could be currently multifamily, but they're using the footprint really bad. Stuff like that is kind of stuff I'm looking at doing. So, yeah.
So you mentioned you find ugly properties and make them pretty, but are there certain age of the properties or, chillers, other attributes, physical conditions that the property has that you'd like to stay away from?
No, I'm not scared of anything. So, I mean, it just, the numbers going to make sense, right? So there's a deal in Fort Worth that we're getting under contract now. Half the property's on a chiller system. The other half is on split systems. And it's all, the whole thing's on boilers. And it's not that big of a deal. None of that crap scares me. As long as you're in an area where you've got good subs that can take care of it, you're fine, right? That's what you get into is like, I did manage a property. It was like 200 units, and it was in a sub-market of Houston. It was like an hour and a half away from Houston. And that was the biggest problem we had. We had boilers, but I couldn't get a plumber to come out there to service the boiler. So that's what you worry about, right? You can maintain your systems. You just got to learn how to do it. But so none of that crap scares me. Foundations don't scare me. Roofs don't scare me. Nothing scares me, right? I can fix pretty much anything. So, and it's great. So it's because I demand a lower price because I'm the person that can come in and fix the thing. So generally, that's kind of where we're looking at. So, yeah.
No, and the reason why I ask is, for personally, we've been looking at a lot of properties that were built in 1970s, 80s, but there's a lot of product that's coming to me in the 60s from brokers, but I'm having a hard time getting, partners and other people really interested in those. And so the thought is that if I buy a 60s property, that's going to be even harder in 5 to 7 years to sell it because we're just adding more time. So, but, chillers, scares our team and,
Yeah. Chiller. Yeah. Okay. Yeah. It scares some people. But if you're repositioning it, right, you're repositioning it. And if it's making money, whether it's 1962 product or obviously the cap rate's going to be a little bit higher, but everything's so compressed right now. We don't know if there's inflation, our cap rates are going to stay low. Like they just are, right? So, and we all know inflation's coming, right? So I don't think vintage matters. I think location matters. And if it's an older product in a really great location, you'll do fine. You'll do fine in 5 years. You'll be able to sell it, right? As long as you figured out the how to maintain the systems and they can see that they're well maintained, they're just going to borrow your game plan. They'll take a look at your game plan and go, okay, we'll use that and we'll just maintain the systems that way. Because at the end of the day, we have a housing crisis in the nation and people need places to live. So if you're making a really nice product out of something old, it's okay. And if the investors are scared of it, go find another investor. There's always a value add investor right around the corner that can recognize that that's a good deal. And you're going to provide them from a value add standpoint. You're going to provide them while there's more risk. The risk is mitigated if you've got somebody who's experienced like I am, who's done a lot of them. It mitigates a lot of your risk on these value add repositions. But yeah, I'm not worried about multifamily in the next 5-7 years at all. It's going to be just fine. It'll be, actually, if you're in any asset class in commercial real estate, you're going to do great. Just go buy now. Go buy now because you're going to be doing cartwheel 5 years. You will, because it's just going to be a really great time. So I'm trying to buy everything I can get my hands on right now. I'm anything I can get my hands on, I'm buying. Because I started buying in 2008. I remember what that was like. That was fabulous. Full loads of money. When we started buying in 2008. Everybody looked at us like we were crazy. I'm like, oh no. We need to go buy everything. I bought an apartment complex in Austin, Texas. It was a little 42 unit. We got it for $37,000 a door. No joke. In 2010. 2010, we had to pay all cash because we couldn't get a loan on it. So we had to go raise the money to pay all cash because we couldn't get a loan, but then we financed it out in about a year. But yeah, I made a buttload of money on that one. It was fabulous. It was great. So yeah.
So I know you invest a lot in Austin, and we were talking before the show that you were looking at Houston and Fort Worth, Bryan College Station. But what are you looking at from an acquisition standpoint in new markets? Are you wanting to be driving distance? Is it all about where your business is located with property management because you're vertically integrated? What are you looking for?
Yeah. So now that I'm scaling a lot larger, I'm doing less and less property management and doing more and more asset management. So I'm partnering with good property management teams. But before I go into any sort of market, I generally have I've kind of done I want, based off of supplies hitting the market, the existing inventory of multifamily in that area, I will have a target for units I want to acquire in that market, that I want to saturate or have X number of units or whatever it might be. So like in Houston, I want 3,000 units, right? In Dallas, Fort Worth, I would love to have another 3,000 units there, right? And I could probably get it in Houston faster because the numbers make more sense in Houston. But I'm starting to see Dallas, Fort Worth stuff come down to where it's reasonable again. So that's the one we got in Fort Worth. That was my first one there. I would love to find stuff in Bryan-College Station, Fabulous Market, and then, Austin and all that other stuff. So so anything in Texas, I'll be fine, right? I can get to anywhere. I keep telling people I'm going to buy a plane. It's so close. I'm so tired of being in the car. I've had to, I chew through brakes and tires because I'm in the car so much. But, and I waste a day driving. There's a property I'm co-partnering on. It's in Amarillo. So, I don't care where it is in Texas. As long as the numbers make sense, I'm good, right? Because Texas is a great state. And then the whole freaking state's doing well. You go to the Valley, you're doing well. You go to Victoria, you're doing well. Corpus, you're doing fine. I don't find that there's many markets in Texas that are not doing well, right? So it just depends. San Antonio, 11% rent growth last year. Everything's doing fine. So, which is good. So, yeah.
So one thing I noticed on your LinkedIn is your background experience in smart building technology. And that's something I haven't really talked much about on our podcast is what are your residents wanting in smart building technology? And does it change in asset classes of the property types, or are your residents wanting, same building technology regardless of, rent price points, et cetera, in a market?
I think what's going to happen is in the Class B, it's just going to get pushed there because it's not something from a tenant demand perspective. It's going to be the owners are going to want it, right? Because when you push smart building technology down to no matter what asset class it is, right? Yes, it costs you a little bit. A little bit per unit, right? But you save, so for instance, leak detection technology. Everybody out there's got a leak detection sensor. Everybody and their brother's got one, right? So but you want it to coordinate with your other systems, right? So it's good to get an IoT device that's going to tell you there's a leak, but it's got to coordinate with some other hub and stuff. And so I actually have a property technology company. I started because I was just so frustrated as a property manager. I was pulling my hair out, right? My maintenance guys are the most inefficient thing I've ever seen in my freaking entire life. So I started one. We're tinkering it now. We're putting it on my properties now, kind of tinkering with it to see if it's going to work. But the leak detection sensors will give you, for different insurance carriers, you can get a 10 to 15% insurance discount. And that's a big freaking deal. You're going to knock off thousands of dollars off of your insurance because you got leak detection technology deployed throughout your property. And those suckers probably only cost $2. It's nothing. So that's kind of the wave of the future. It's pretty happening in Class A. Everybody's got, keyless technology to get in their door in Class A, right? It'll push down to the classes. And if you were an early adopter like I am, right? You're gonna be able to differentiate yourself between everybody else on the market because nobody's doing it yet. So it'd be great because you can come in and then your property's gonna be full because they get the ooh-ah because I walk up and I can use my phone to log in the door, or I can do this or have an Amazon locker or whatever it might be, right? So I can use a keyless technology. I can give a code to a guy who's coming. The maintenance guys can come in and do whatever they need to do, and I don't need to be there, and all this other stuff. So it just facilitates a lot of stuff. And so there's a lot of stuff on the smart building technology around maintenance. That's kind of the stuff my company's working on. There's a whole lot of stuff in the property technology, and it's a budding field. There's a lot of people chasing it, a lot of money's chasing it. It's real estate for the longest time didn't have to evolve because you didn't have to be very tech savvy because they made a crap ton of money anyway. I bought multifamily properties from people who did their accounting on paper. Like, no joke. Like tenant ledgers, like freaking on paper, right? And so I'm like shooting, I'm like, please in Excel, like something that I can underwrite with. But I had to go basically redo all of their financials because everything was on paper. So, and they made money. They didn't lose money. They're making money, right? So nobody in the commercial real estate is like 80s maybe at best on some people, right? But now they're starting to adopt more technology. And as they do, right now the race is on, right? So if you can get a good property technology, like RealPage will probably end up buying you out at some point. But if you've got a good solution, you can really drive down costs, because right now that's the biggest scare, right? There's a lot of stuff on the chasing the revenue side, like on leasing and how you do leasing efficiently and gain efficiencies in leasing and do your cost per lease and keep it down, right? Because you can use a lot of technology around that, right? So that one's easy because you can easily match up your revenue to whatever it is you're buying, right? So everybody, that's generally technology starts and you'll get to somebody like me, where our technology is on the cost side. We're going to save you money. We're going to save you a crap ton of money. Sometimes I can quantify it. Sometimes I can't. The fact that your maintenance guy doesn't have to walk back and forth 5 times to the maintenance shop to find a freaking part to figure out your problem, and he spends half a day on it, or like, but I can't, you can quantify that. So how many times in a year does it happen? I don't know. Nobody's watched your maintenance guy, right? So, so there is efficiencies you can build. So that's what we're doing right now, is figuring out our case studies around it so that we can go, oh, okay, great. Now you used to have 2 maintenance guys for a 100-unit property. Maybe I can get you 2 maintenance guys for a 300-unit property because they got diagnosing skills. So it's different. So that's kind of where I'm at with it. So it's really, really early, really early. But a lot of property technology is going that way. It's about enabling good decisions through data. Right. So there's a lot of stuff on the ESG side as well, around utilities, smart meters, sub-metering the properties so they're smart meters. So you can tell, you can give the tenants, they can get visibility in what their bill is going to be. So yeah, it's pretty cool.
Yeah. I love how I didn't even think of it more on the ownership side with who's going to be pushing it, but you're absolutely right. And that leak detection, that's something that, we're looking at our properties as well, because it's pretty low cost to your point and does have that insurance saving. So I think that's a huge key takeaway, that it's not just the residents that are wanting more of the smart technology, but really the owners. So really well said. Yeah. So thank you and I can tell your passion is in that as well. So with your,
yeah,
which is great. So with your business on this, is this something that others can contact you on and learn more about, or what services do you provide on that?
Yeah, it's real early, so I talk about it because I don't have products I can sell yet. I can install it and I can get through it, but it's not something where I'm ready to put it in the box and put it on a shelf. Right? It's not ready yet. And there's a lot of hardware that goes into it too, and so we're tinkering with who's our preferred vendor we're doing. So we're still in tinker mode, but I'm ventured to guess by how things are trucking along now, in about 9 months or so, we'll be ready. I'll have a product that I can sell to other folks, right? Or actually, what I'm going to do is because for me, I do it one way. So I'm going to call my friends who own apartments and go, hey, you want a really cool system for cheap? So I can can you guinea pig my stuff, man? That's basically what I'm going to do. So yeah. And so maybe in about another year and a half. Yeah. So maybe about 18 months, I might have something that's got it for people. Yeah.
So obviously you're very data driven. You've got passion behind the smart technology and such. So what are software systems and tools that you've used to help manage your processes? It sounds like you're going more third party for property management services. So what are you looking for them to have when it comes to software as well?
So with all my property management companies, kind of it written in our agreements is I'm like, I have to have a direct API into your property management software. I mean, like I still want an account and that's really cool and that's fine. I can get in there and look at it. But I want an API where I can pull all the data down because we've built out our own dashboard. So I had, a couple of Baylor kids. I live in Waco. So I have a couple of Baylor interns and they helped me build out this really cool asset management dashboard, which makes my life great. Because I'm a property manager. I mean, I used, 4 or 5 different property management softwares. I have never found one that gave me the reporting that I needed to manage effectively, right? It gave you some of it, right? And they gave you like the known things. But when I was trying to get really good insight into renewals and kind of where people were and where, and then like income management and all of the other stuff, I had to pull pieces of data together and it wasn't real smooth, right? So we just created one. And so as long as you API the data down, right, then it's easy. As long as they have the data, they can do it. And we use a software called Tableau, and that helps with like just creating the dashboard itself. And if it's using API, then it's live and linked and it's nice. And it's every once in a while we have to pull down data so we have static reporting because the flow is not static, right? It changes by every second, right, depending on what's going on and the data that you're pulling. So depending on how you do your downloads. But so it's nice. I like it a lot. That's made my life a lot simpler. And I can look across properties. I can look across portfolios. I can look at one property. I can drill down into one. So it's really nice. And I spent, I paid a lot of money for those kids to kind of create that for me, but it was nice. So and we still tweak it. I have a business analyst on my team, and that's their job. They are like, I'm like, go to this. I want to see this. And so and then they go off and they do their little coding thing. And it comes back and I'm like, no, that sounds like, and then we'll go. So I've got my little minions that do data for me, which is fabulous.
How are you finding your minions at Baylor and these other, in your case, Baylor, but it's something, now that we're in Bryan College Station, I thought of the same thing with A&M. Like how do you attract and find those people?
Yeah, interns. Go to the Office of Career Planning and tell them you have an internship. And that's how you find them. You get the fabulous students, and you're competing, especially A&M. I would love to get an A&M intern. Like, it'd be great. And we actually had some of them they do over the summer. And so as long as you got an office where they can come hang and you get them all set up or do whatever, they'll do some really cool stuff. And you can get engineering interns. You can get computer science folks. I mean, I've got Baylor. So I just get interns, and I just get them, and it's nice because I get them throughout the school year at Baylor. So you can get A&M interns, and it's, you're going to pay them. I mean, you're going to pay them. Like, they're not cheap, but for what you're paying them, and they're just freaking fast. They're kids, and they don't sleep, and it's like, you go. Like, I'll give you more coffee. Like, just go. It's fine. I don't care if you sleep. Give my crap done.
A lot of, I've used it as well, Upwork and Fiverr, and those have worked really well. But, I'm just thinking back in my early days, like you're hungry for those extra jobs and opportunities to build out your resume and all. So good on you. And one thing I love about podcasts is, we go different directions as the conversation goes. So hopefully that benefits some listeners and not just me, for sure. So, hey, you had mentioned a lofty goal early on in this podcast about, you wanted another 3,000 in Fort Worth or 3,000 in Houston. The reality is that it's hard to find these properties that are good deals, but 2, raising capital to buy the properties can be a hurdle for most people. So how are you structuring or going about raising capital? And for somebody that's newer into this industry, what are some lessons learned or advice that you have just for that capital raiser?
Okay. So the deals that I'll just tell you about the deals I'm doing now, and then I'll give you advice. So the deal is ever like, it's like somebody turned on a water hose and just pull it on full blast. Like, I get so many freaking deals now, I can't underwrite them all. So, and it's really interesting. Everybody's understanding the deal flow fatigue. Like, everybody's in deal fatigue at the moment, right? You can't underwrite everything that's coming across your desk. Some of it's going to be bad, some of it's going to be good. Like, you do that's a bad deal. Like, move on, right? Because you just don't have time because there's so many deals. I'm finding more deals in Houston. I did find one at Fort Worth. It's all about broker relationships and relationships with people, all networking. When you've been doing this game as long as I have, your name gets out there, and people, like the other day, some Yahoo head from New York calls me, and I'm like, hey, I want to partner with you on a deal. I got this deal in Houston, and yeah, we need a boots on the ground person. I never met him before in my life, and it was like a 520 unit deal in Houston. And I'm sitting there and I'm looking at it, and I'm looking at the deal, and I'm like, first, I don't know you, so tell me who you are. But then I'm looking at the deal, and I'm going, this is not a good deal. Y'all, like, look at the cap rate you're buying it at. Like, just that alone, I was like, y'all are overpaying for it. And it might turn, but you just need, not right now with the impending chaos headed our way. Don't overpay right now. That's just silly, right? You don't want to overpay for anything right now. So I'm looking for stuff where I'm going to walk in and I'm already getting it at 100 or 200 basis points above what the market cap rate is, right? That's what I'm buying. I'm not going to buy anything at cap rate right now. I'm not paying full price for anything right now, right? Because we don't know. We know that there's crap's going to hit the fan. We do know that's happening in the next 6 months, right? Next couple of quarters, something's changing. We all can see it. The banks are hiring foreclosure specialists. I mean, like, when they start hiring foreclosure specialists, they know what's coming. They know what's on their balance sheets, and they know they're going to have to foreclose on stuff, right? So kind of reminiscent of 2008, 2009, which I lived through and started real estate investing in. So yeah, deals are not a problem for me right now. I'm finding a bunch of them. How I raise capital right now is now I'm starting a fund. I used to do syndication after syndication after syndication, and that game gets old, especially when you're doing 2 or 3 deals at the same time. It's tough. It's not easy. And so it sucks. Honestly, truly, it sucks. It's hard. So I'm starting a fund, and our first one will be $50 million, and then we'll start raising for that here next month. And we're off to the races and start, we have plenty of deals to stick into it. That's a problem. It's now changing your capital raising from deal-specific syndication to you need to invest with me because I'm groovy cool and I have a very track record, right? So it's a different model of raising money. Now, I will, pitch them all day long, the deals that we already have. So it might be fairly easier on the first one. It's not truly just, hey, invest with me because you like me. It's going to be, invest with me because you like me. It's in a fund, but I have these 3 deals. So it's going to be nicer. So yeah, that's kind of what we're doing now. So for the first person, it's like, this is your very first raise. I'm going to go back to when we did 2010. Now, your very first raise, when you're going to ask people for money, you need to understand, the couple of things that you need to understand are, you got to understand if you're bankable or not. That's the one thing you need to know. Do you have the liquidity and net worth to knock down the loan? You need to go find somebody who does, right? Because you will not get a loan. If you don't get a loan, raising money is silly, right? You don't want to do an all cash deal like we had to back in 2010 because your returns are just horrible when you have to do an all cash deal. So, figure out if you're bankable, right? Talk to a commercial broker and they'll tell you if you're bankable or not. It's really kind of straightforward. It's like, do you have the net worth of the loan you're trying to get? Yes or no? No, I don't. Okay, great. Go find somebody who does. And then, do you have liquidity? I mean, you might not have the net worth, but you might have the liquidity, right, that you need. Whatever the liquidity requirement is. Sometimes it's 6 months, sometimes it's a year, sometimes it's 3 months. Just depends on what they want you to have sitting in the bank. So that's number one. Number 2 is they're actually going to go raise capital and talk to people. Marketing takes a lot longer than you think it does. It takes a long time. It takes you like at least 90 days before you start building momentum, and then you have to maintain that and push that, and it might take you 6 months to a year before people really know who you are, right? So marketing, it has to be a constant train. If you suck at it, please hire somebody who's good at it. Like, don't try to do that yourself because you'll just shoot yourself in the foot. It's like don't do accounting if you suck at accounting too. Like, that's the other rule too. Like, just don't even bother. Like, you'll get yourself in a world of hurt there too. So if you have the cash where you can save up some money to invest in your business, which your business is a real estate investment firm, marketing is one of those functions you need to have done. Accounting is the other, right? So those kind of things. And then And then not being afraid to ask for money. That's the biggest thing. People don't ask people for money. And I don't get it. I'm like, you're a capital raiser. Go ask them for $100,000. Go. Go. And then when they tell you no 100 times, then you go, okay, great. I understand, but why? And then when you find out why they turned you down, it could be a variety of reasons, but that's the information you need to know so you can craft your message so you can do it the next time you talk to an investor the next time, right? People are going to go, well, I don't know you. I'm not going to give you $100,000. I don't know who you are. I don't know what your record is. Oh, great. Okay, great. Let me start marketing what my record is. Let me start marketing what I've done, right? And then you talk to the next person. I don't like your hair color. Okay, great. Thanks. All right, move on. And then it could be anything, truly. Like, they could not like you. There was a great quote, I think somebody the other day was like, you're going out and you're talking to people. 25% of the people are just not going to resonate with you, and they're not going to like you. So move on. Stop trying to sell to those people. Just move on, right? Like, just chalk it up. Okay, I got to go talk to the next person, because it's a sales business, right? Raising capital is a sales business. And if you've never sold anything a day in your life, if you've been an engineer or project manager or whatever, you never had to sell anything and you're going to go ask people for money, well, might be good to get in a sales training class, because that's all this is. If you never run a business, you've never done that and had to learn how to be a salesperson, because that's what it is. You're selling people on yourself, that you're going to trust me with your money, and I'm going to take your money and not party with it. I'm actually going to buy a property with it, and I'm actually going to improve that property and give you a return, right? That's what you're trying to, have people do. They have to trust you with your money or with their money, right? So anyway. Yeah, it's kind of an interesting gig, but marketing takes a while. That's one thing. Hire somebody if you suck at it. Hire somebody. If you suck at accounting, hire somebody, and know if you're bankable or not. Like for an intro person, that's what you need to do, and then that'll get you farther along. And then eventually, when you've been doing it as long as I have, right, you'll start funds and you'll start doing stuff and having a grand old time raising money. I wouldn't do anything else. I mean, this is what I was born to do, apparently, is to buy real estate and create investments and do stuff like that. So it's just kind of nice that I found my calling. It's kind of cool. So, yeah, long answer.
It was a perfect answer. And there was a lot of information there that I would love to just keep digging in on. But a few of the things that stuck out to me was one, and I love what you said in this, because I see very eye to eye, and it's a reason that I'm really haven't bought anything this year personally, because to find a deal that is at or below cap rate mark, I mean, it's amazing how aggressive people are getting on deals, in my opinion. It's just my opinion, on deals just to make it work. When I'm with you, the signs are there that over the next 6 months to a year, there's going to be some sort of correction. I don't know how big the correction is. Nobody does. But the key to any market, at least this is what I took away, previously, and then from you just now, is never overpay. Real estate will definitely provide that wealth and those returns. But if you overpay, you're just having to pretend. It may get you where you need to be, but you may need to wait longer because of what you did initially, right? It's that beginning. So I thought that was pretty key. And then the other thing too, that I'd love to dig in more on, and hopefully spend a few more minutes on it, is this fund. I'm seeing more of this from syndicators, where they're doing more of a fund situation. And I love that too, because it helps diversify the passive investors, capital investment or their investment. So what are some lessons learned, and what have you been seeing through the process so far of doing this fund? And what a lofty goal. You said, what, $50 million? That could buy you a lot of real estate. So congrats on that. But
it can.
And it will. So what's your lessons learned on those funds so far?
So far that I've learned, so it seems to be a fairly straightforward process to set up a fund. It's a blind pool fund. And so it's like a Reg D, same as like a syndication. You can do a 506B or 506C. Obviously, we're raising $50 million, and I don't know that many wealthy people. So we'll do a 506C, which means I can advertise it, right? And what I'm finding is that so as far as getting it set up, it's not much different than the regular syndication, right? It's the back end stuff is a lot more stringent. And the back end stuff is lot crazier. So my, like your investor portal has to change, right? Because some investor portals, the people are set up for syndications, but they're not set up for funds and fund accounting and how do you determine that? That's where it gets weird, right? It's like, how do you determine somebody came in on this date? We already have these properties. Like, what percentage share? They get all weirded math, right? And so you have to have a really good fund accounting team that does this day in, day out, and you have to have this. So the front end's easy. It's the back end that'll kill you, right? So, and I've already talked to some of those folks about how we do all of that. And there's different funds too. Some funds are like a menu where you can pick, I want this property and this property, but I don't like that one, right? You can set your funds up different ways. So it really kind of just depends. And most of the fund I'm starting it's going to be it's like for most people's brains, it's like a mutual fund. So you jump in, and the date that you jump in, you're getting to participate in any sort of gains of whatever the shares that are being held by that fund, right? So, and that's kind of my first go at what we're going to do. We do already have so the amount we're going to raise, we already have deals kind of in our pipeline that we're negotiating with sellers for. So it'd be fairly easy. We're going to okay, you're going to give us your money. And oh, by the way, these are the 3 deals you're going to do, or these are the 4 deals you're going to do, right? That won't be easier than trying to, over a year, try to find properties that fit our criteria, go find them and do stuff like that. So, but yeah, that's what I'm finding so far. It's really your back end. You got to have a good partner that knows what they're doing. And I think I found some people. I started this fun conversation over a year ago, where I was really kind of investigating it. I wasn't moving very fast. I was trying to figure out, okay, what is it going to look like? How are we going to set it up? We're going to my partner. She's going to manage the accounting side because I ain't doing that crap. And who are the good ones? And so really been investigating it for about a year, no joke. And so I think I finally found the folks that I like, the portals that I like. So we'll kind of see. I have to get some more demos from some other. I'm sorry, my nose is itching. Investor portals, but yeah, so we'll move on that fairly quickly now, but it's been a long process. I mean, I said, oh yeah, I'm going to start my fund next month, but I've really been looking at it for over a year. It's not like something everybody's like, oh yeah, I'm starting a fund next month. And they've probably done the same process, truly trying to investigate how it happens, what you do, at least 6 months or so. Really, I've been busy, so I've had to hear, but yeah, it's you don't just go do that stuff, right? And it depends on, you don't have to do, some people do, depending on the Reg A or whatever. So if you did a Reg A plus fund, right, that's a whole other ball of wax versus just doing a Reg D 506C fund, right? So, just depends on how you want to structure it. The Reg A is going to take you longer, just so your listeners know. It does. It takes a lot, 4 to 6 months, maybe, depending on how bad COVID is and if people are in the office, maybe longer, right? Because Reg A has got a lot more requirements than Reg D does. So, anyhow, yeah.
Well, definitely something, in that 18 months or 12 months, whenever we get you back on the show, love to learn more about, but that's really good to know about the back end too, and that the accounting piece and, how the splits and all work out. And if the market starts declining and you have that cash in hand, it's even better opportunity. So the timing seems to be really good for that.
Yeah.
Yeah. So a couple of questions here with your massive experience, and, just so where you have started from in your career and where you're at now, what are some of the most overlooked aspects that you're seeing in real estate investing in general, whether that's syndications or these funds? I mean, what cringes you at night with seeing people making these mistakes? Because we all have that, right? We're all oh,
yeah.
So what is that? What is that so the listeners can, look out for and hopefully better themselves?
From an investor standpoint, I really think that the investors are getting, so there's a lot of groups, right? There's a lot of things and a lot of education, a lot of stuff out on social media. And I think investors are getting into deals that would not necessarily qualify. They would not be qualified for. They're not even sophisticated. They don't understand the underwriting. And yet sponsors are taking them in their deals. And it's scaring the living bejeebies out of me because there's just so much money chasing deals right now that I'm just like, y'all, like, I mean, I'm getting, and so if I get a weird sense that somebody doesn't understand what they're investing in, I just don't take them in my deal. But I have to have a conversation with them. But there's just like, and I have to train my staff, like my investor relations manager and my acquisitions manager, people like to understand. I mean, they know what we're doing, but if they get a sense from an investor that they don't know what they're doing, we can't take them. I mean, like according to the SEC, we can't take them because they're not sophisticated. They have to at least be sophisticated. There's that, so that makes me a little bit cringe. There's that my processes are making sure we're not getting somebody into any of my deals that don't really, I don't want that. I mean, they're going to get a lot of education because I do a lot of communication, investor communication and stuff. And I'm going to make sure our deals perform, but still I would like before they got into it to understand what it is that the hell they were investing in and not, oh, I really like Amy, so I'm going to give her my money. No, I really want you to understand what the hell this is and what the risks are. And like, you just got to understand that because it's not if, it's not, I mean, it's not when, yeah, it's not if, it's when. I mean, you're going to get still sick or happen like it does. And so you got to, you know, I get people like that. I mean, mine are value add, so they take a long time. Like this is not, I'm going to give you cash flow distributions every month starting, 90 days from when I bought it. No, it's value add. So you got to understand it's different. I mean, a lot of people don't understand that either. So I'm trying to do a lot of more investor qualification right now because there's just a lot of that. And then what's feeding that is what I'll get on my high horse about is all these guru people. His first name is Brad, will get up there and tell people that anybody can do what I do. Anybody can be a sponsor, whatever it might be, right? And they're the ones that are making all the money, right? Just sitting there. I was at a conference and that joker got up there and was telling people that. And I'm like, no, my job is really, really hard. And it takes skill and it takes experience and it takes a lot of different things. And not everybody can do this job because it sucks. And by the way, we work 90 hours a week for that damn money. And like, nobody wants to do that either. That's why they're called limited partners. They don't want to work 90 hours a week, right? I mean, like, so crazy. But yeah, so that's my other thing. And this one right after the other, selling their education, telling, oh, that's easy. It's easy to do multifamily real estate. It's easy to do this. And you can go make $1 million. And like real estate is a get rich quick thing, but everybody equates get rich quick to easy. And it's not. Real estate is hard and it takes a lot of time and it takes you to build up systems. And when you don't have the systems, that system is you. You got to do all the manual work and do all this other stuff till you get it set up to where you have systems because you can afford them, right? And you have employees and you have all these things. But in the beginning, it's just you. You're doing everything. You're doing the counting. You're like, plunging the toilets. You're like doing everything. And, but it's kind of an interesting thing. So those are my two big things. I think investors need more education and they need to stop throwing their money at stuff that they don't understand. And then the Yahoo heads need to stop telling people, the guru dudes, and they're all dudes, by the way. No woman would ever say that. But all the dudes are saying, oh, yeah, anybody can do this. No, not anybody can do this. There you go. You let me get on my soapbox and vent. It was fabulous. I'm so excited.
But this is awesome. This is awesome because people do need to get educated about this real estate investing, whether it's multifamily or anything in syndications. You've got to be, knowledgeable, sophisticated. I'm gonna do a plug here, but we do the fourth Monday of each month. We do a virtual meetup, and we do that for this exact reason, Amy. Like just to teach and educate. And we have people on, and it's not we don't get money from it. We're not. At the end of the day, we just want people to make good decisions about. Maybe real estate investing isn't what you want to do. If you are putting in your last 50,000 and need that money a year from now, then this shouldn't be the investment for you. This is potentially a 5 to 7 year, like your money is being used for something, especially if it's value add. It's already part of the plan repositioning of that asset. So I think it's key. The other thing, there are these great programs out there. Some are better than others, but at the end of the day, it's a lot of work. And so I feel your passion, and just to even find an opportunity, the amount of hours, amount of money that goes into just the systems and the processes that you're talking about, so well said. And I love your passion about it, because I think it's very true in so many ways. So with that said, I always end with this question, and then I'd love for you to share on the show, how listeners can reach out to you. But what are your proudest moments in real estate investing and real estate in general? And again, how can people reach out to you?
I have got a lot of it. Proudest moments in real estate investing. I guess when I was a sponsor and we had done a really, really fabulous thing, and I was the life of the party because I just cut everybody's checks. They got their capital back, right? Because we did refi. So it was a major refi, and we profited from it, and everybody got their money back. And I was the belle of the ball. Like, I was just so, but it was fabulous, right? Because those people had invested with me, and I was able to turn around in 19 months and give them their money back. And it was great, right? And so that was nice. That was really nice. So those moments are, but they were still in the deal. Everybody doesn't think, but they're still in the deal, right? So they got their money back, and they could go invest it into something else and still be in my deal, right? And we're still cash flowing and stuff like that. So it was great. It was kind of cool. So that was nice. And then how can people reach out to me? So my website is T as in Tom, M as in Mary, the number 1, TM1 Properties.com. And that's my website. So if they want to, they can register to invest in my investor portal there. It's the yellow button. I tell everybody just press the yellow button. And they can kind of see the offerings I have. They can learn more about me on my website. I'm obviously on LinkedIn. I'm not on Facebook as much. I'm there, but I'm not on. I don't use it for business. So I'm on LinkedIn more. And then obviously my website's the best way to get hold of me. I do have a white paper on my website too. 15 ways to create value. It's kind of, I wrote it a while back. But anyway, so there's that too, is on my website. So yeah.
Well, Amy, thank you so much for your time. I know you're, even as of today, you're out looking for properties and look for opportunities for your investors and your wealth, which is awesome. So love getting to know you today, and I can do anything for you, let me know, but you have a great rest of the day. Thank you so much, Amy.
You too.
That's all for this episode. We hope you subscribe, share, and leave a review of the show. For more information about passively investing in multifamily apartments, check out Wayne's free ebook by going to CREIPartners.com/ebook. Also, follow us on Facebook by searching CREI Partners. This was the